Activity 69. What we're going to do now is we're going to compare straight line with double declining balance. We computed straight line in activity 67, and we computed double declining balance in activity 68. So if you remember from straight line, these are the results that we got, 70,000 a year, and double declining balance, these are the results that we got, nicely typed. So now activity 69, let's compare the two. And what you should do is compare the balances for yourself and then watch the rest of this video. So put the video on pause and return to the video after you finish the activity. Okay, good job. In the first year of an asset's useful life, double declining balance depreciation method is going to report, if you notice, depreciation expense that is higher than the straight line method. Because recall that, so I'm trying to get this black. Recall that depreciation expense was in the first year 160,000 under double declining balance, but it was only 70,000 under straight line. Now, what about income? The net income in the first year of life would be lower because depreciation expense is higher, therefore net income is lower. How about accumulated depreciation? Accumulated depreciation under double declining balance would be higher. Look at the number. It was $160,000, whereas in year one, under straight line, it was only $70,000. And total assets would be lower because the book value of the asset in year one is only $240 under double declining balance, where, if you remember, it was $330,000 under straight line. There it is, $330,000. Now, in the final year of an asset's useful life, and what we mean here is year 5. Let's look at that. Year 5, under straight line, we had $70,000 worth of depreciation expense, and the ending book value, the accumulated depreciation was $350, and ending book value was $50,000. In double declining balance, the depreciation expense was only $1,840. Because remember, we had depreciated the whole thing. There was nothing left to depreciate. And accumulated depreciation again was $350. Book value was $50,000. So let's answer the questions. The double declining balance reports depreciation expense that's lower than straight line. And it reports net income that is higher than straight line. So which method you use may seem to be academic, but it actually affects net income. Accumulated depreciation is the same. It was $350 either way because you had fully depreciated the asset down to $350. And total assets that are the same because the book value of the asset at the end of its life, at the end of year 5, the book value of the asset was $50,000. So book value does depend on which depreciation method you use. Now, book value, you can see it's a very mechanical approach that we use to determine book value. There's no way that book value is going to be the same as the current selling price. Current selling price is going to be determined by the market. And book value is determined using this very mechanical accounting kind of way. Now, let's look at the next question here. If an asset has an acquisition cost of $20,000 and accumulated depreciation of $10,000 and no residual value, then on average, the assets are recently purchased, halfway through their useful life, old and ready to be disposed of, or you can't tell. And assuming they're using straight line, then it's halfway through their useful life. If it's double declining balance, it's actually a little younger than that. But it should be about halfway through its useful life because it's half depreciated. So the more depreciation you've recorded, the further along you've gotten in the useful life of the asset. An accelerated depreciation method is double declining balance, and that means that a greater amount of depreciation is recorded at the beginning of the asset's useful life, and a lesser amount of depreciation expense on the double declining balance will be recorded at the end of the asset's useful life. building is being depreciated, then you could use either method. If an auto is being depreciated, you can use either method. It's up to you. Now, land is never depreciated. It lasts forever. Which one makes the company look better? Straight line or double declining balance? And the truth is that it depends. When the asset is young, SL makes the company look better because it records less depreciation. When the asset is older, there is little or no difference. Then when the asset's older, then double declining is going to have less depreciation. So double declining balance will make the company look more profitable. That's activity 69. Thank you.